Good afternoon and welcome to Real Wealth Network's weekly webinar. I'm Kathy Fetke, co-founder and co-CEO of Real Wealth Network. And as you know, I've been a little obsessed with this whole opportunity zone thing. And I will give credit to Tim Horvath, who is here with us on the webinar today, because he called and said, I know you're busy, but do you want to talk about this? And then that was it. Off we went.
That is true.
Yes, just when you thought you were going to have a quiet rest of the year, Tim. Sorry about that.
That's okay.
All right. So if you are new to our webinars, if this is your first one, please know that we're not going to be talking about taxes today. We just did two webinars with two different CPAs, and they are on our website. We're going to be kind of showing you how to do that. If by chance we end up discussing taxes and muddle through that, please don't take it as tax advice. We are not CPAs and we can't do that, and you'd be not getting the right advice. But anything we do say, bring to your CPA and ask those questions to them, because that'll be important. But even more important than that, a lot of your CPAs may not even know anything about opportunity zones, so have them watch the webinars and have them come to our upcoming live event too. We expect to have a lot of CPAs and attorneys there to learn, because this is all new. So with that said, the strategies mentioned today may not be appropriate for everyone. In this case, this is all really specific to people who have capital gains, because this is really going to benefit you if you have stocks or real estate or a business that you've sold. This is going to be a really fantastic opportunity. And if you don't have that, you can create it over the next few years, because there's some time where you can create capital gains and then still invest in these opportunity zones. But anyway, consult with your accountant, tax advisor, and attorney to discuss your specific situation. Of course, past performance is no guarantee of future results. I see a lot of people making this mistake. Don't make that mistake. Don't think that whatever so-and-so just did or accomplished in the last 10 years is going to be your results in the next 10 years. Very, very different environment out there, which is why I am always just dumping all of this information out to the public so that you can see that times are changing, and you've got to be aware of where we are in the cycle so that you understand that maybe past performance is predictable for future results, but you would have to look at past performance at this time in the cycle. So you'd have to look at, all right, out of all the times that we were at the peak of the cycle, what was usually coming next? So that, you can look at it that way. But anyway, real estate purchases are subject to investment risk, including the possible loss of amounts invested. So you got to know that. You've got to be very careful when you invest your money in anything. And while every effort is made to maintain accurate and current information, the possibility of errors and or updates exist. And that is especially true for the opportunity zone, because it's not finalized. So as much as we're all guessing that it's going to work this way or that way, they haven't really come out with the final regulations. So we're trying to be ahead of it. And there was new information just released at the end of October that has given much more clarity, but we won't probably have the final until January or February. But let me tell you, we're getting ready and queued up for it, and so that you can be too. All right, and to help us with that, we have invited Ryan Shellhouse to join us at our next live event. We weren't going to have a November event. Everybody at Real Wealth Networks was going to take the month off, and we were kind of excited about that. But then Tim brought opportunity zones to my attention. So really, you can blame Tim for this one.
If mama's not happy, nobody's happy is what I've learned.
That's right. So November 10th, we are focused entirely on qualified opportunity zones. We've invited Ryan to discuss it. We think it's going to take the full 3 hours to really understand it and how it applies to you. We're going to be taking your questions. Bring your CPAs, bring your advisors, bring your friends, bring your partners. This is 3 hours that will cost you lots and lots of money meeting with your CPA. Sometimes I've gone to our attorneys and asked for legal, and legal advice on our syndications, and boy, I come back with a really big fat bill. So I'm requiring our attorneys to come to this so that I don't have to pay for it, so that they can come and learn, and not bill me. So this is a really great opportunity for sophisticated investors. If you are in the Silicon Valley and you've got friends, at any of the booming tech companies in the Silicon Valley or elsewhere, and they've had stock options and they're looking at the end of the year going, oh man, I don't want to pay on that, then please bring them. This is vital information and they can do something about it before the end of the year. And that's why we're holding this event in November instead of December, when you'd have a lot less time to figure it all out. So again, Saturday, November 10th in San Mateo, 12 to 3, Sunday, November 11th in Los Angeles from 2 to 5. And we also have some things we'll be talking about at these events that we can't share publicly. I can't talk about it today. I really want to, but I can't. It's an SEC rule. So please register for the event or register as a member of Real Wealth Network. You would need to fill out our accredited investor gate. You don't have to be an accredited investor to do it, but you just fill out the form. And at that time, it will unlock parts of our website that are private. And we'll be able to call you and have a conversation about some of the things that we can't talk about publicly. I can't talk about it on the podcast, can't talk about it on the webinar. We can't post it on the website. It is private. We can't put it in our newsletter even. We can only discuss a lot of the things we're doing with people with whom we have a pre-existing relationship. And there's a whole lot of ways that the SEC defines that relationship. And the first step is filling out that questionnaire. So again, you can do that at realwealthnetwork.com or just sign up for the event and it will show you how to do it there too. We have somebody coming to speak at the event that, again, I can't mention. So I'm sorry. It's just the way it is, but fill out the form. If you've already done that, you're going to be getting the information. It's very exciting. Can't wait to share it with you. All right. So with that, we're going to talk about some things that we can discuss today on a public webinar like this. And Tim Horvath, our Director of Affiliates and Properties, is here, and Adam Whitmire, who's been managing our turnkey fund that's closed out. So, we won't be able to get into that, but he has been working very closely with Tim on that fund. So welcome, Tim and Adam.
Thank you, Kathy.
Thanks, Kathy. Glad to be here.
Glad to have you here. So we've been, as I said, we've done 2 webinars on the accounting side, the tax side of opportunity zones. We're not going to be talking about that today because we're not accountants. So please go watch those. They're archived webinars on our site. But we've been getting just a ton of questions saying, okay, well, what's Real Wealth Network going to do, and how can we work with you guys? So that's what we're going to be addressing today, how Real Wealth Network can work with our members in these opportunity zones. The process for that, it's going to be different than what we've been doing because for many reasons, can't be a renovated property. So there's a different way that you would need to acquire property through our network. And then we're going to take your questions and answers, and we're going to be able to answer some of them, but not all of them. But any questions you send, we will make sure they get answered eventually on a future webinar or podcast when we have an actual CPA here with us. Unless we can get one on the line by the end of the hour, then we will. All right, so how Real Wealth Network can help you with opportunity zones. Whenever you're investing in an unfamiliar real estate market, the best strategy is often to partner with or employ someone who's already operating in that area. So Tim, boy, I'm going to just throw that over to you.
Yep.
That's a really big and open-ended question, but that's really why Real Wealth Network exists, right? Because so many of our members want to invest in areas where they don't live and they need a team. So anything you want to say about
Yeah, absolutely.
this
I want to, the day that I called you and I knew you were busy and I asked you if you knew anything about these opportunity zones because I had 2 of our affiliates call me I never heard them so excited. They're like, we're already in these areas. We can do all this stuff. And I'm like, I don't even know what you're talking about. So I started doing some quick research, and that's when I gave you a call and said, Kathy, what do you know about these opportunity zones? And I heard your voice go up, so I knew I hit something. And what's so great about this is, like I mentioned, a lot of our affiliates already we're already doing stuff in these zones and in different markets, and we'll get to those later down the road. So this is a huge opportunity for us. We're already there. We already get the teams. We already have the property management. All my teams now have been with me since at least 2 years. And so I have a history with them. I feel really good. So it's just like everything came together at one time. So it's like the perfect storm for us.
So okay, there's more slides, so we'll go into more of that because I'm sure there's some new people.
And this is just more about the affiliates like Tim was talking about.
The affiliates that I mentioned, that they're already in these areas. We have history with these affiliates. So it just makes total sense to keep working with these affiliates and grow, especially in these opportunity zones. Now you have the added advantages, which we really can't talk all about that, but if you listen to our previous webinars, you will hear that. But it's like I said, it's just a great opportunity for us to work with teams that are already on the ground, boots on the ground. I know the areas well. I spent a lot of time there with them, and I'm just really excited about it.
So to just summarize it, and again, I'm not a CPA, so always consult with your own CPA. Do not take anything I say or Tim says or Adam says as legal or tax advice. Just use what you hear today to talk to your own advisors. But the way that this works is that if you have a capital gain, so if you sold a property or plan to, or you made a bunch of money in the stock market or in cryptocurrency or in whatever, if you're selling your business and you have to pay that gain, you can now defer the payment of that tax until 2026. And so you can sell whatever that thing is, and you have 180 days to invest it in an opportunity zone fund. That's the way it's written. So that has, of course, a lot of people opening up funds, right? For today's purposes, we're going to talk about you having your own fund because we can't talk about our fund publicly. So you would have to, again, become a member, and then we can talk to you about that. So on today's webinar, we're going to be just talking about the aspect of this new tax law that allows people to open up their own fund. Now, there's a whole lot to it, and I actually just did a podcast on it. There is a lot of regulation around opening up your own fund, but you can do it. And if you want to manage it, do it yourself. We've got the teams, Ryan Shellhouse for one, who will help you set that up. It really is as simple as opening up an LLC, which most of you have already done, or a corporation if that makes more sense for your strategy. And it's my understanding, again, that it needs to be a partnership where it wouldn't just be a single member entity. So it can't be just a husband and wife thing, is the way I understand it. So for the purposes of today, if you don't want to invest in somebody else's fund, you just want to have your own, and you have, I think we have a slide on this, so I don't want to jump ahead.
Yeah, we have a step process.
Okay, great. So it's going to be a very different process if working through, if you're going to do this on your own, but work through Real Wealth Network's affiliate teams around the country, it's going to be a different process that involves, hiring a contractor, a property manager, and so forth. So again, anything you want to add to this, Adam or Tim, this slide before we move on?
I think that's good. I think that's a good intro to affiliates.
Yeah, we're going to go over the 5-step process now.
Okay. So, and then again, for anyone new to this is the only time I'm really going to talk about the tax part of it. But the idea why this is so great is that when you can reinvest your capital gain into an opportunity zone fund. And if you hold it for 10 years, then you get a 15% discount basically on the gain you pay on that first capital gain. But on the capital gain you get from the opportunity zone fund, whatever that property is or whatever you invested in there, if you hold it for 10 years, you don't pay any tax on that gain.
That's the magic.
That's the magic. And that's why the strategy is you really want to get into deals and opportunity zones that are going to increase in value. It's not so much a cash flow play, although that's great and wonderful. But the real goal, the real target is to increase the value of the business or property over a 10-year period.
A point to make there, Kathy, is the cash flow will be taxed normally. That is public knowledge. And
Yep.
the real magic is the 10 years when you would sell your property or your fund.
Yep.
That's when you'd get the magic would work.
That's right. So there's a whole lot to it. People are going to be asking about, can I flip property? And, there's all sorts of things you can do. But for the purposes of today, we're just going to talk about the good old buy and hold strategy that we've been doing forever, but just a little bit different. So who wants to go over that 5-step process here?
Go ahead, Mr. Adam.
That's right. Thank you. So, we talked several times about meeting with your CPA because it's really important that you follow the guidelines. There are guidelines, and there's a certain way it needs to be done. You are going to be required to set up an entity, like Kathy said, and they can advise you, a professional can advise you on what type of entity, how to set it up, and to make sure it's done properly. So that's your first step in meeting with those professionals. Next, you want to really, as far as how we can help, you can, if you haven't already met with an investment counselor or have one that you've been speaking with, that'd be a good time to meet with an investment counselor and to get one, because they can give you information that we're going to be feeding to them. We've already been working with and talking with affiliates in a number of different markets, looking at the opportunity zones within their markets geographically, and kind of, seeing what areas look good, what opportunities look good. And so your investment counsel will be able to point you into the right direction as far as which affiliates are currently focusing on opportunity zone investments in those areas. So once you figured out where you want to go, where you want to be, what type of real estate you want to invest in, again, the whole strategy here, or the way to maximize the opportunity zone strategy, is to get the most capital gain possible. And they kind of force you to do that a little bit by making you put in the extra time for the rehab, which is put in the extra money. So that's a benefit to you. That's not a bad. It's a great opportunity, because it means you're going to be participating in the value add from the very beginning. So that being said, though, it's not like you're going to buy something that's performing. The idea is you're going to buy something that is either underperforming or not performing at all. So these are value add opportunities, is what we call it. And that being said, there's a few more moving parts than what you would normally see. So acquisitions is going to be a little bit different. There's going to be a renovation process. Many of you who've been buying turnkey properties may not have been involved in the renovation of the property. There's a lease up process. If you've owned rental properties before, you probably had one go vacant and then had to lease it up. It's not going to be much different than that. But we just want to kind of hone in on these processes, that there's going to be more moving parts, and there's some additional things you need to think about. And the biggest thing you want to think about is when you're doing value add, is this is not always going to go like you think it's going to go. So let's go through some of the slides, and we'll kind of walk through the process a little bit. We talked about meeting with a CPA or meeting with a professional, and that's going to be really important. Also, as you're working with different affiliates in different markets, you don't know what they know and what they don't know. So you want to kind of keep an eye on this as well. You hope that they know how the guidelines work, and that they do, but you always want to make sure that you're aware of what those guidelines are also, so you don't miss out on an opportunity. And again, your CPA or tax attorney can help you with that. Investment counselors, if you haven't worked with an investment counselor, you're really missing out on a fantastic opportunity to talk with someone who has actually worked with dozens and dozens of different investors, and to help them invest in different markets. And they're to help you come up with your plan and your strategy, and help advise you as far as what's available. And they'll help you get that information that you need on the research that we're doing and what we're finding in the market as well. So they're privy to a lot of that information. So you definitely want to speak with an investment counselor. Acquisition process. So when purchasing an opportunity zones, here's some of the things that we've heard. You're going to need to verify these things with your CPA, but you want to make sure that there's that it meets substantial improvement, which means that you're going to buy something and you're going to spend money on it, and then you're going to go back and spend twice as much money on it to add some value. And it could be just to renovate the property, to fix it up, or it could be a property maybe that's already kind of performing but needs a complete a big facelift or a big addition. It just has to be substantial improvement. And that has to be done, I believe, within the first 30 months or so. Again, this is the information that you want to verify with your CPA, but this is what we've been told. Substantial improvement means that one must increase their cost basis in the property by about 100%. Now, that does not include land. We're only talking about the improvements. And if you're wondering, well, how much of it is land and how much of it is improvement? Well, one way you can document that or answer that question is to go look at the tax assessor site and see how much of the value does the local municipality add on land, and how much of that value do they put on the actual improvements of the property. Now, that being said, it doesn't mean that you have to agree with the way the tax assessor's done it. If you don't agree with how they broke it up, maybe you can have your own appraisal at some point and allocate those numbers. That may not, this is typically not something you want to do if it's a small investment. But in other words, you don't have to go by what the tax assessor says. If you can back it up logically, if you've got some documentation or way to back it up, you can actually use a different value for the land than what they're showing. But at the end of the day, so we're going to take whatever those improvement value are, and we're going to double it up. We're going to add that much more money into the property to increase the value, hopefully increase the value of the property. So that's again, that's one of the main differences here than what you've done before. So let's go on the next slide and talk about what that looks like. What those moving parts are.
And I just want to jump in and say that a lot of it is different than what we're used to doing, because there are areas where, our affiliates were like, it just doesn't make sense. Like, these are great areas in the path of progress and everything Kathy loves, like potential growth and stuff, but the cash flow wasn't there. So, now we're looking at it saying, who cares? Like, if it just cash flows enough, that's fine. If
That's
this
right.
is really an area that is in a major path of progress. Okay.
And last thing I want to say something real quick on that. We're working with our affiliates and Adam and Kathy, and we're coming up with a criteria. So just because it's an opportunity zone doesn't mean it's the right opportunity zone for us. Yeah. So like Kathy says, it's a path of progress, and is it already almost connected to something that's already thriving? If so, then that's a winner for us. If it's way out by itself and there's nothing around it, then we're probably going to pass on that, or recommend that you pass on that.
Yeah, that's a really good point. And this is a capital accumulation play now. This is a strategy. It's not just about the cash flow. It's about, is this property going to appreciate in value? Are we going to be able to add significant value to it? So if you invest in a property just because it's in an opportunity zone doesn't mean it's going. What if you don't have a capital gain? What if it doesn't appreciate? So you need to make sure you're executing on that properly.
That's right.
All right. So this is a big part about it. This is the part that may be new to a lot of them. This is the renovation, and this is not a light renovation. These are heavy renovations. If you purchase a property for $100,000 and you have to put another $100,000 in renovation, that is not a small renovation. Okay, and so there are some things that we want to. This is probably the part that we want to caution you the most about, and the part that we want to make sure that you have really have a good grip and a good understanding on how to do it, what could go wrong, and kind of how to prepare for this and what to look for.
And the beauty of working with us and our affiliates, we will set this process up. So if you decide to do this on your own through us and our affiliate, there will be a process that they will agree to, then you will agree to. So we'll make sure they walk through the process to make sure everything's accounted for before you get too far along the project.
That's right. The renovation, this is where you're going to add value to the property. So on the previous slide, on the acquisition side, we've identified a market, and maybe in that market, like Kathy said, we've found some areas that are in the path of progress. That means if you're on a street and the street kind of goes way downhill toward the end of the street, that's a great place for you to be. But if you buy a building that's boarded up, and all the buildings around it are boarded up as well for the whole block and the next block, you may have a problem. Then you're on an island, and we want to avoid islands. We want to stay on the path of progress. So
yeah, the only way that would work is if we went in and just revitalized the entire area.
Yeah.
yeah, we bought every single
Yeah.
one of those boarded up houses and made it fantastic, then that could work, and that's certainly something we're looking at. But Tim and I went out to an area that looked so promising initially, because in addition to the opportunity zone, there was also some city money that was going to come, tax credits, or just basically credits from the city if we revitalize this area. But Tim's team and due diligence team just felt like it just wasn't going to turn soon enough. It would take longer than 10 years. So we're still looking at it, but it just might take too long. But
Yeah.
yeah, so we'll see.
Yeah, if it would have been a town in front of that one, we would have probably been all over it. But there's 2 towns they'd have to go through to get to that one. And so far we're doing more research, but we don't think it'll turn in the 10 years that's needed to make the best profit on it.
Which is too bad, because it's near a city that Tim wanted to visit a lot. Let's just
That is very true.
That's right.
otherwise
That's
known as
about, you know,
Las Vegas.
well, that's, yeah, Las Vegas. Well, as long as it's not too far away from Las Vegas.
We're trying to give Tim a good place to visit, because he's, Anyway, that we'll see. There might be other parts that work, but that particular neighborhood, that it's like no wonder the city there is trying to like bribe
Right.
people.
Yeah,
But
some of them
anyway,
are challenging.
Yeah.
You still have to look at the piece of property and say, is there potential here? Can I make something of this? Is it being undermanaged? Is it not, maintenance and work hasn't been worked on in a long time, or is it just not being utilized properly? There's a lot of ways to improve the value of a piece of real estate. So you have to identify that, and you also have to identify, are we going to be able to prove the value enough? In other words, we have to buy real estate that's going to require some significant renovations. Because again, the whole point is increasing the value of the property through the renovation, and also looking forward to some increased appreciation over time. And if it's a cash flowing property, that usually comes in the form of increasing rents over time on the rental property. So when you're doing heavy renovations, obviously you want to work with a contractor who is licensed and insured. You want to have a contract with the contractor. You don't want it to be verbal or written in an email. So basically, if you basically working with a contractor and you've got a property that needs some substantial renovation, you want to get a scope of work. And I know some of this seems elementary, but you would be surprised how many times all these little things are missed, and these little things are fundamental and elementary for a reason. So
also, Adam,
yeah,
a lot of
ahead.
people are selling stock to now invest in real estate, and they maybe they don't know these things. And I had someone come to me and say, I bought a property that they renovated, and it didn't. I wasn't happy with what I ended up with, and this wasn't through our network. But I said, well, what did the scope of work say? And he's like, the what? So he heard renovated, but there was no definition of what that meant. So his idea of renovated was different than what the seller was doing. So of course, any agreement ever needs to be in writing with a bid, and get several bids, and make sure you truly understand. I had another person say they thought the appliances were included, but it wasn't written. So there's no standard for what renovation means. We have our real wealth standards, so take that with you. But in something like this, you may not even want to necessarily do the real wealth standards for something like this, because you might want to maybe do just the basics for now, and then and meet the criteria, but then do the full renovation in 10 years when you sell or something. So but with the key here being, just get it in writing and make sure you've got a draw schedule. Never ever send all the money at once. Only send the money.
That's
right. You have to give them a little money in the beginning, right? But then you don't send any more, and you're going to go into that. So yeah, go into that part. That's important.
That's probably your biggest risk. And before you get there, when you close on this property, the insurance you get is going to be a little bit different because it's vacant, as opposed to getting a property that has a tenant in it. This is a vacant property. It's going to be a property that's going to be under construction. So you want to make sure you have the right type of insurance going into it when you close. Now, when you work with the contractor, If you're doing this on your own, and it is a kind of a larger project that you're working on, you probably want to get more than one contractor bid. The worst thing that could happen to an investor is you get a bid from a contractor, you go into it, and all of a sudden you have to fire your contractor, or they back out, or they say, we thought it was going to be X amount of dollars. It turned out to be twice that amount. And so sometimes you want to get multiple bids from, 3 different bids from a contractor. And that way you can see if, it gives you a good feel if that number is going to be good. Because when you're doing these bigger renovations, first of all, you need to understand it's not likely to happen in the time frame that the contractor says it's going to happen. And it could. It's just not likely to. And here's the other thing. It's not likely to happen for the dollar amount that the contractor says it's going to happen for. That happens a lot, but when you're doing larger renovations, and if you're building a house from the ground up, it's easier to understand what the costs are. But if you're going in and tearing stuff out, putting stuff back in, it's really hard to know what's behind the walls and what's under the foundation, or what the pipes and electrical behind the walls look like until you actually start pulling things apart. Tim, did you want to say something about that?
No, that's not.
Okay.
I'm gonna, at the end of it, I'm gonna talk about the beauty of working with our team. So go ahead.
Okay, good. So you're going to see a lot of these things when you're doing a larger renovation. They're going to have more complexity. So don't get heartburn because it's not always going to. It's just not. You just have to have a little buffer. So if you the renovation's going to be $50,000, maybe you put a 10% buffer on it. Maybe or a 20% buffer on it. Whatever you feel like, whatever will kind of make sense. But so you get the scope and you get a time frame. It can't be open-ended. And all that needs to be in writing. With your contractor should say, this is what we're going to do on the property. This is how long it's going to take. Here's what happens if we take longer. Real simple. And then basically, then you kind of start managing and tracking the process. Here's the other thing is, often out there you hear a lot, hey, give us half up front, half in the end. 50% up front, 50% in the end. At the end of the day, you just have to have a draw schedule. Okay. So giving somebody half up front works okay when you're talking about a smaller amount of money. When you're talking about a very large amount of money, it gets a little bit more complicated. But you have to have a draw schedule. It's like Kathy said a minute ago, the more money you put out at one time, you got to look at the risk. What if that contractor takes my money and doesn't do the work? Or what if they do the work poorly or badly? So you just want to make sure that you're not out too much money at one time.
And Adam, we highly recommend that the draws go through a title company. So they have to get the draws from the title company that you approve. So they they can't just grab money when they want. So we have to do you have to do a very good job, and this is what we'll be doing as well, is holding them accountable, because nobody starts off wanting to do things wrong. It just kind of sometimes happens that way. So you want to make sure that the money's in a title company, they're holding the escrows, you approve it through a process that we develop that you agree to, and then the draws are released on a schedule based on completed work.
And that's one of the best ways. That is one of the best ways to do it. Typically, when you pay a contractor up front, you're paying for materials. They go and do work a couple of weeks later, depending on how long. So let's say if the project's going to take 3 months to complete, maybe you do 3 to 4 draws. Maybe you give them you put down a deposit sum up front to get materials with. You do a completion, they get a third of it done after the first 30 days, and then you put out some more money then. In the next 30 days, they get 2/3 done, and then the last 30 days, you want to have some way of doing a kind of an inspection along the way. And then once it's completed, would be a good time to do a final inspection, or even have a home inspector actually go through the property.
Yes,
to make
absolutely.
Sure nothing imperative was missed.
Yeah, and you can even use a home inspector at the beginning and then have the same home inspector at the end, but do not pay that final draw. I can't make this any clearer until the home inspection you agree to at a home inspection is finalized.
Do not. Let me repeat what he just said. Do not pay in full until the job is completed.
And then you'll want to
do that.
Yeah, and then you're going to want to make sure you have your lien waivers, and we'll have this all process all for people that work with us and our teams. We'll have this process all laid out for you, but you're going to want to make sure all the documentation is signed off. There's going to be a whole checklist that you'll have to check off before they get that final draw. So that's how we protect ourselves and protect our membership.
And the only reason that we're telling you not to do that is because you're going to be, contractors will ask you for that. You know, they're going to tell you every difficult, sad, challenging story that you can think of to get you to give them more money whenever they need it. And you really have to, there are exceptions, you know, things that come up that were not foreseen, but at the end of the day, you need to make sure the work's completed and to make sure the work's completed properly. So just to, you know, so that's the most important thing. Draw schedule, inspect what you expect, and make sure the work's being done along the way. That's probably this renovation. This is the most challenging part. This is also the part where you make your money.
That's right.
Right here in the renovation. So, Tim or Kathy, do y'all have anything else you want to mention about renovation before we go on to leasing? This is really
I think the
rubber meets the road.
Yeah, I think
I just want to be clear that you know, this is not passive. Okay. So what we're showing you right now is a way to, you know, for anyone who just joined us, to use our teams through Real Wealth Network that we already use for quote unquote turnkey properties, but this would be not turnkey. So there's more risk. And there's more involvement on your part. It's not passive. There will be other more passive opportunities that I can't discuss here. That's why you need to make sure you join as a member and fill out that form, and then we can discuss it. But this is if you want to open up your own opportunity zone fund, which can just be for you, you know, and your family, and you need one other partner in there. Talk to your CPA. It will require some work. And Ryan said about 10 people called after the last webinar, and when he explained what needed to be done, they said, you know, we're going to wait for the passive deal. Like, we don't have time, but we wanted to at least explain to you, if you wanted to do it on your own, this is how you would do it.
Yep, and this is the model that I did for 10 years before joining Real Wealth Network, so I know it very well.
Yeah, absolutely. You're earning your money. This is where you earn your money, because like Kathy said, it's not passive. You actually have to do the work. You have to give oversight and you don't micromanage. You're not going to have to, you know, call and schedule crews, but you're going to have the stuff that we're talking about. You have to keep your eyes on there. You have to count your dollars. When you're an investor and you're investing money, your job now is to count your money. Make sure you keep an eye on your money. You know what your money's doing. You know your money's going to work every day. That's what investors do. Their investment tool is their money. So that's what you keep an eye on. All right, so let's go on to Lease Up, which is going to be not going to be as complicated. This one's pretty simple. Step 5 would be let's lease up the property. Okay, whether it be a single unit tenant or a multi-unit property, there's always a lease up process. Once the renovation is complete, you've had an inspection done, verified everything's done, it looks good. And then you pay your contractor the final, they're done out of the picture. One thing that I would recommend, if you know you've got a leasing company set up already, have them come in maybe around the time after the inspection's done, but before your final, and just have your leasing agent do a walkthrough, and they may be able to give you some insight on, hey, you know what, in this market, if you do something here, something there, whatever, they can tell you, oh, I can lease this property quickly, or I could lease it quickly if you had this or that. And again, that's probably a person that you may even want to have involved during when you're figuring out the renovation, what it's going to be and what it's going to look like. Have your leasing agent involved a little bit earlier to give you some insight on that market would probably be helpful as well.
That's great advice, Adam. That was how we did a lot of ours. And it's added a few extra things, and we got more rent and got a better tenants just by adding simple things.
Yeah, little stuff like that. Those are just want to have everybody collaborate. Now, same thing with your property management company. There needs to be a property management contract, and this one you're probably more familiar with, right? There needs to be a property management contract. Get to know the property management companies. make sure that you've kind of checked them out, to make sure that you've gotten referrals, and whether they do a good job or not going to do a job is going to be really important on this, as far as how soon or how long it takes for the property to lease up. But just understand this: when it comes to property management, there are two components. There's the leasing component and there is the property management component, and they require two different types of personalities. What you'll find in property management companies, you'll find some that are very good at property management and they're not very good at leasing. And on the other hand, you'll find some that are very good at leasing and sales, and they're not very good at the analytical side, the management side of the equation. And so you just need to make sure you understand the personalities there, understand their track record, get as much information as you can. You want to ask questions like how many homes are they managing? How long have they been managed? How long does it take up to lease up a property in this area typically? Do you typically do single tenant properties or multi-tenant properties? And you just want to kind of get a feel. What does your annual maintenance look like on these properties in this area? You know, they're also probably going to be the one to help give you the comps, the leasing comps on the properties that you're going to buy an opportunity zone. You know, you want to get some leasing comps. One thing that I always did is we would pull comps and figure out what a property would lease for ahead of time. And then once it's done, whoever our property management company, we would have them do the same thing. I always like to get multiple opinions on what people think that this property will lease for, or what they think a property is going to sell for. And once the property is leased up and they get into the management phase of the property, you know, you're going to want to make sure that they've got security deposits and rents. You know, some people don't like those numbers to be the same number. All that's going to be different depending on the market. So we won't be able to go into that kind of detail here. But at the end of the day, the property management company needs to inspect the property. So that more than, you know, on some type of regular basis, probably even more than once a year. The last thing I want to say about property management companies would be that you're not going to give somebody an asset that you paid all that money for and not give it any kind of oversight. So part of your oversight is managing the property. The property manager is not passive either. You have to manage them. That means you have to make sure that they're going to inspect the property and do a walkthrough either quarterly or twice a year, or however often they're going to do it. They need to get in there and make sure the tenant, especially maybe if it's the areas it's a little bit lower rent, and in certain areas where tenants might not have the same pride of ownership on the property and take care of it as much. So at the end of the day, just you know, just make sure that you've, you know, done your work on it. And that's pretty. Let's go on to the next slide. That's pretty much it for the management side. Okay, questions and comments. Actually, Tim, do you want to jump in and talk about some of our affiliates and kind of how that's set up?
Well, if you've been a member or if you're a new member, you'll know that we have some awesome affiliates, and a lot of you probably already purchased properties with them. And since I've been with Real Wealth for the last 3 years, just once again, we've great relationships with this group. We're almost like a community. And they're already in these zones and they're already in these areas. They've already been tested, battle tested, because they're doing this model and then they're selling to our members as rent ready. So they're already doing it. Now you're just gonna step into the point before it's rent ready. So just like Adam, you had said very clearly, there's going to be it's not going to go as smooth as you always want it to go. Just know there's going to be some bumps along the road, but working with a group of people that we have strong ties with, that have already proven themselves, will help us get through those ups and downs. So that's the beauty of having the network. And remember, having one house with Real Wealth Network is like having a couple thousand houses. That's the kind of position that we're in by if you're having issues that you need help. It's easily for me to call and say, hey, here's what we need to do, and you're not going to be alone. So that's the beauty of Real Wealth Network, and we're going to take what works in that model and apply it to this model. So we will not let you be there by yourself, and we're excited about implementing this whole thing. It's just we can't wait till the new rules come out. And I never heard my affiliates be so excited as well. They call me daily. We're having phone calls with them, and so they're all over this as well.
I'm going to tell you one of my ideas, and this is this is not official at all, but you have to have somebody else as a partner in your opportunity zone fund. So it could be interesting to potentially, if you're going to work with one affiliate, that they get a very tiny percentage, because they're going to need to be watching over these properties for 10 years. Because you need that third partner. But again, that would all need to be run by legal, and they would have to want that. But and you would have to want that and have a great relationship. But that's just one possibility of keeping them interested and on top of things. But please know, we do not own these companies. A lot of people say, well, shoot, since they're approved by Real Wealth Network, I'm going to just cut corners. I'm not going to pay the $350 to get that inspection, or the $350 for an appraisal. I'm going to save that because they're through Real Wealth Network. So they're automatically great. And let me just please stress that is not wise, because we're not there. We can't walk through it. I wouldn't do that through my own mother or daughter. If they were selling me a property, I would still want to get my third-party inspections and appraisals, because you just never know what maybe got missed by accident, or maybe somebody took a drink of water that had the wrong chlorine in it and their brain went, like, you've got to make sure that you're covering yourself, because just because someone was great for the last 10 years doesn't mean that something might happen to them that would change that. So you have to stay on top of things. For example, we had a wonderful team in Cleveland, and all at once his wife got breast cancer. This was years ago, probably 10 years ago. His wife got breast cancer, and his cousin was shot and killed, and all these things happened at once. And he was just not able to oversee his company the way he'd normally had, and he put someone else in charge, and that other person in charge did not have the same standards. So, we can only do our initial vetting and say, wow, these people really meet our standards and our core values, and we approve of them thus far. But that doesn't mean that you don't do your due diligence. You still do all of it. You still must do all of it if you're buying direct like that.
Well said, Kathy.
All right, thanks. Okay, so here's some questions we have. How are the ozones different from the 1031 exchange? Oh my gosh, someone is doing some work next to us. I'm sorry it's so loud. We can't really talk about the tax stuff, but I'll tell you just very quickly that if you are planning on holding your property forever and you never want to pay tax, and you want to pass that property on to your children, then you definitely want to do the 1031 exchange instead of this. Because with the opportunity zone, you will pay tax in 2026. And you may not get your money back from the investment until much later. So you have to have money set aside to pay that tax. I'm going to mute myself, and you guys say anything you want, because it's really loud outside my window.
All right. Yeah, that's all right, Kathy. So this is stocks and bonds and any other capital gains for 1031s. Because you will have to pay that tax in 2026, the 85% of the original tax, because the magic happens, remember, after 10 years. And so just you have to have that money set aside. And another option is that you can actually sell properties in an opportunity zone fund, one as you reinvest it in another opportunity zone fund. So that's another way of kind of pushing that can down the road.
You got to think about, from a strategy standpoint, the goal here is to accumulate gain. And so the benefit, though, is the gains that you made while you were in the opportunity zone, you don't have to pay taxes on those at all. If you're worried about a property, like Kathy said, you're selling it now, it's got a huge gain, you want to defer that gain like forever and keep doing 1031 exchanges, this may not be the best strategy. But if you're okay with paying 85% of that gain and in 2026, and you really want to build up a gain that's completely tax-free through investing in opportunity zones, this could definitely be a good strategy for you.
Another reason why this is cool is, let's say you have a property that you paid $500,000 for, now it's worth $1 million, you've got a $500,000 gain. All you have to do with the opportunity zone is invest the $500,000 gain into the opportunity zone. But the $500,000 that you initially put in to buy that property, you can just pocket that. You can't do that with a 1031 exchange. It has to be the whole amount. The whole $1 million would have to go into the replacement property. And you would be deferring, and you'd have to hold that till you die. The only way you get cash out is through loans. So if you need the cash and you just want to sell the property, then the opportunity zone is better. If you want to never pay the tax and have your kids inherit the property, and then the property stepped up to market value and you never pay it, that's great. However, 1031 exchanges, it's not an ironclad law. I mean, that can change where you defer, and then suddenly they change the tax law and it's not stepped up to market value when you die. You know, like so who knows? Nothing lasts forever when it comes to comes to laws. So you have this window right now that really for selling businesses, it is ideal because you've never been able to do this and invest it into property. If you're selling property, you really need to think about your long-term strategy, and that's why you want to talk to an investment counselor and your advisors in making that decision.
You know,
all right. Go ahead.
Another good benefit, Kathy, is that the fact that they're doing this opportunity zone, it is going to cause values to go up because you're going to have a lot of money. So there's additional opportunity to get value that wasn't there before because you're going to have so much more money poured into the same areas that you're investing in. That's going to help a lot on those gains.
Yep, that's why the path to progress is the best.
And we're not going to tell anybody where we're investing. This is very, very private because we know a lot of our competitors and a lot of hedge funds listen to our webinars and go to our website. They tell me when I'm at these fund events, that they're copying us. So we're not going to tell anyone where we're investing until after we're invested. And when y'all are in there and you got your money in, and then they can come in and drive values up.
Unless you send me on a trip to Vegas.
Yep.
That was a joke, SEC.
All right. Can vacant land in the opportunity zone be built upon if double the land cost is spent on new construction? I don't know that we can answer that, but yeah, you can absolutely build.
Yep.
Yeah.
I recommend listening to your podcast last night, Kathy, because Ryan went over that. That was something new that I did not know.
I know. Did you hear my surprise?
I did. Yeah, you got excited. Yeah, I wrote it down.
Oh, excited. So absolutely, we're going to be doing a lot of that. But the beauty is you get to subtract the land value, and you only have to improve the land by So it's different. The only problem, and I don't know the answer to this yet, is that right now the way I understand it, that the funds have to be deployed within 31 months. So you have to be able to build fairly quickly within that time frame, unless there's something I don't know about, building from ground up, if they're going to give us a little more leeway, because sometimes it's going to take 3 years just to get the entitlements, So not always though.
I think for most areas of the country, except there are certain areas in the country that is challenging, but most of the areas, especially the ones we're looking at, you can build a house within 6 months.
Good. Well, that's great. So don't do it in California then.
No, don't do it in California. That's not one of those areas.
You might not get there to get it done in 31 months. But again, I think there'll be some leeway there, and we're waiting for clarification from the Treasury on how that exactly works for new builds, because I'm excited to announce some of the plans we have for that. All right, if I buy a property for $50,000, of which $10,000 is land and $40,000 is improvements, how much renovation do I need to do to qualify for the O zone? 41 or 41,000 or 51,000. In other words, is the improvement amount based on the total property cost or the property minus the land?
41,000. So it'll be minus the 10,000.
Minus the land is the way we understand it. Yep. And that just came out end of October. That was not clarified until now, that land value could be deducted. So very cool. All right, tear down or partial tear down? I think you just have to do improvements.
Yeah, that's where the strategy is going to come in. Kathy, you had mentioned it because one of our affiliates, which I won't name, had the same opinion that was whatever the requirements are, let's make it that nice. And then in 10 years, let's then put the rest of the money into when you're about to sell it and you really get the bang for the buck. Because in the areas that we're looking at, by putting an extra $15,000, $20,000, $30,000 isn't going to get you any more rent or make the house any nicer for tenants. So it makes more sense to just do what you need to qualify, get the right market value for the rents, and then at the 10-year, when you're ready to sell it, that's when you put the facelift on it. That's when you put the granite countertops. That's when you make it look pretty. That's when you add the extra added value, and that's where you make your money.
All right. From my understanding, most of your affiliates are turnkey models. I'm particularly interested in Tampa. Do you have any affiliate that Use the value add model. So this is what we're trying to say is that we have 15 affiliates approximately that we've worked with for years, and that Tim has really he's working with them to share best practices, and they're masterminding together, and they're all helping each other get better. We're a very close network. There are some within our affiliate group that we will be training on this model. And so that's why you need to talk to your investment counselor at Real Wealth Network to find out who's ready to do this, because they're already doing it. They buy properties, they fix them up, and they sell them. So it will just be reverse, where you buy. If anybody's heard TJ speak from Pittsburgh, he's the only one, pretty much the only one who's been doing it this way, the BRR method, to buy, renovate, refi. What is it?
No, it's
Rent.
buy, renovate, rent, and then refinance.
Yeah, so he's been doing that where, he'll find you a property, you buy it, then he offers a scope of work of what he thinks needs to be done to get it rented, has the draw schedule and all that, and so you're sitting on a property that's vacant and is in renovation. So it's very different. There's a timeline there. It might take 6 months that you're not getting cash flow because it's being renovated. You don't know if there's going to be surprises. There often are. You know how that works. You fix one thing, and the city inspector comes in and says, oh, now you got to do this. We found this, and blah, blah. So things can change. And that's why there's a little more risk to doing it this way. But it's what our affiliates are already doing. They buy, they renovate, and they rent. So it will just be reverse, where now you're buying it, you're hiring them to renovate it, and you're hiring them to rent it. So yeah, it's just a little different.
You're getting that value add. That's the key to it.
Yeah, and then you get to decide. See, we've had lots of fights with our affiliates, basically saying, look, we have certain standards that we want these properties in. We want our investor to feel like they're getting a fully renovated home, and so these are the standards we're looking for. But sometimes the affiliate will say, but this HVAC doesn't need to be replaced, and we say, well, we don't know, so replace it. And so you might say, no, don't replace it yet. We're just going to use it till it runs out. And so you might be putting less into it initially, with the understanding you have money set aside to do those things later.
Correct.
Yeah. All right. So it's definitely not passive. It's more active, and our teams, some of them will be set up to do this. And many of them are already operating in areas that are now opportunity zones, because that's been our gig from the beginning, is to buy value add areas. So that's how I started, was buying property in an area that wasn't known, it wasn't on the map. It was in Texas, in a little town called Rockwall. No one knew about it, but we knew that a new freeway was coming in and it was going to be hot, and that ended up being the case, and those properties tripled in value. So it's always been my thing to kind of get into the area that nobody knows about yet, but has lots of potential. And that's where these affiliates are already in. And now some of these areas, you get the additional benefit of the opportunity zone. So we don't want them going into areas they don't understand, or they don't like, or they don't know how to manage, or that's not the deal here. We want to be doing this in the areas that they're already in, that just happen to now be qualified opportunity zones. Anything you want to add to that?
No, that's exactly right. We're not looking to reinvent the wheel here. They were already there. They've already kind of do this model. Now we're going to work with them to put a process in place to protect our members and protect themselves. So we're doing it to help protect both of them.
Should we also answer a question that we do have people in Tampa? She's interested in Tampa.
We probably shouldn't answer that.
Am I allowed to say that? Okay, let's not say that.
Yeah, we do. We have that. I mean, just go on. All you have to do is go on our list, go on our website and look under invest, and you'll see all the markets that we have teams in. And we haven't finalized with all of them there's going to be a process here of making sure they have a checklist of what we're expecting and how we're going to be advising you all to do this. And follow these guidelines.
And just because an opportunity zone doesn't make it the right zone. So that we're vetting every area they tell us that they want to do it in, and I'm going out there, Adam and I's going out there, and we're walking it, we're looking at it, and that's how I like to do it. I like to look at it, smell it. I like to hang out at the local coffee shops, the local bars, and kind of get a sense for what's going on.
That's why you're at the bars. I was not
right. It's work. Reason. It's all business.
I had to justify my expense for it somehow.
All right. Okay. How do we acquire a list of the areas where these opportunity zones are located? Well, you can send the check to my office, and I'll get. Just kidding. No, it is totally
Okay.
public information. Just here's the tip of the day. Type in opportunity zone map, and you will get it. It's on a government website, and it is so cool. You'll see them everywhere. Yeah, there was the question. Yep, it's on the map. It's on the website. Can we expect Real Wealth Network to be offering something passive? Yes. However, I'm not able to discuss it on a public forum because it's a private placement. The Securities Exchange Commission requires that. So that's why you need to be a member. You need to fill out the accredited investor form. It's just a form you fill out. You don't have to be accredited investor, but you have to fill out the form. And then that will open up all of the part of the website that you can't see if you're not a member. It's private, and I can't talk about it because this is a public webinar, and there might be someone from the SEC listening. So there you go. All right. So once the form is filled out, to hear more about Real Wealth Network and ozone items, but not be attending a conference, how will that be handled? We will know that you filled out the form, and we will be able to invite you to private webinars and send you unlock parts of our website that have everything you need to see there. We usually do tours to the area wherever we're doing deals, and that's another way to meet with us. And we're also going to be doing a few more events that are not just West Coast based, because I know that's hard for people who don't live here. But usually the way it works, if you can't come to an event, is you will, once you fill out the form, you've been put into a special group that's our private placement group, and you will be contacted and invited to private webinars. Are these properties entirely cash only? If unoccupied, low performance, there must not be a loan. So the question is it a cash purchase? You know, that's a really good question. Do you guys know the answer to that, or should we wait for the CPA to address it?
We're waiting. Actually, there's been a number of questions about the instruments. I've heard you can, I've heard you can't, I've heard lots of them. So we're waiting for clarification on that.
The biggest problem I see is that it has to be an opportunity zone fund. It has to be a fund. And so that means it's an LLC or a corporation, which means that you would need to have a lender that would lend to that. I don't think you can take it out and get the loan in your name and put it back in. So you'll have to find a lender that will lend to an LLC. Now we know them, but and they're out there, but they're not the kind of great loans you get normally. There's not going to be a 30-year fixed or anything like that. They're going to be commercial loans most likely. And you know, Adam is just like the king of knowing every great lender out there. So you know, he can certainly compile the list of who might be lending to these funds. But that's
because
just
there's actually only a few of them that are actually good.
Yep. Yep. All right. Are these and so it basically, I guess the question was if then the commercial lender is going to be looking at performance because that's what they do. So it'll be interesting to see how that plays out. Even if it is allowed, who's going to lend? Do we need to invest this year to defer 2018 gains? Listen to my podcast I just did. It's up live now. He talks about that. And the way I remember it, but please check with your CPA, is that you can sell now and you have 180 days to get it into a fund. Is that what you guys heard too?
Yes, and also Celia did a great job and put some links into the questions. So for our webinars, they can just click on that and get those links.
Right there under the chat. If you just click on chat, you'll see she put links. And also you just go to realwealthnetwork.com, click on learn, and you'll see the archived webinars, and you'll see it there. Or you could just use the search button in it and just put opportunity zones, and it'll come up that way. I sold a property in June of 2018 and then found out about this amazing program. So I have another 30 days. Can I set up the fund first and purchase a property past the 100? You have to get it into a fund in 180 days. Let's just reach out to us as soon as you can, and let's see if we can help you with that. We might have some solutions there to get it done in 30 days. When will the recording of this webinar be available? Usually Jill gets it up pretty quick. So I don't know, 24 hours? Does that sound about right?
Yep, Jill's really, really good at this, so she
She
will take
is
care of it.
awesome. Yeah, so it should be up soon. If I'm building an opportunity zone fund with a non-qualified entity, could I purchase the property with my new opportunity fund? Let's see. If I'm buying in an opportunity zone with a, okay, so if somebody maybe, it sounds like maybe they're already in contract with an entity buying in an opportunity zone, could they purchase the property with the new opportunity fund entity? I kind of think
I
that Ryan talked about that on the
I
podcast.
think I think the fund they're saying it's a non-qualified fund. I think if you're already buying in an LLC, this is not a specific type of LLC qualified opportunities on LLC. It's just basically it's just a normal and there's only certain entities you can do, but they're normal entities, and you just declare them. Hey, well, from the taxes, you just declare it that this was purchased in an opportunity zone,
But the
and
LLC, the entity has to, the sole purpose has to be for opportunity zone.
Yes.
So if he's,
90% of the assets in
Yeah,
there have
90%.
to purchase
so
an
I think
opportunity zone, and they're going to check that twice. You have to
yeah.
twice a year, I think.
So it sounds like maybe he's using an LLC that was not originally set up for opportunity zone. And so can he open up a new opportunity zone fund? And
Again, I don't think you have to open up a new one. To my understanding, you have to
well,
check this
don't
with your
let's Adam,
CPA.
don't answer it then if you don't know.
Yeah,
Just want to
yeah.
make sure yeah, talk to one of either your legal person or one of the CPAs that we recommend or your own to get that answer because yeah, definitely don't, if we're not positive, we don't
Yeah,
ask.
it has to be a certain type of entity for sure, like Kathy said. And
Yeah.
the main thing is that the properties in there are purchased in opportunity zones.
Yeah. What areas in class do you like to work with? These are, you're not going to have a choice on class. These are opportunity zones are economically distressed areas. However, whoever did the zoning, I mean, every metro area got
Yeah, that's
to
right.
submit it, and they got the approval, and there was clearly some politics involved because some of these
Definitely some
opportunity
politics.
zones are
Some of it
really
looks a
nice.
bit arbitrary.
Some are close to water, so it's hard to believe that this needs to be, but that's a good thing.
There's some in LA, there's some in San Francisco, there's some in areas that were like, what? I mean, I just went to an area that I always thought was a great area, and it turns out it's opportunity zone, and it is not distressed. So you just have to go on the map. You can go online. It's just shocking. But with that said, the intention, most of these qualified opportunity zones will be distressed lower income areas. So it's probably C. Although, like I
Yep.
said, we've seen some that are B and
Yeah,
some even A.
we love C plus B, and everybody knows that that's who most of our affiliates work with. Some of these areas will be C pluses, but we will know in the path of progress, and there's soon to be Bs because all the money coming in that area will take it right up to that. So we take all that into account when we look for where we're going to work, who we're going to work with, and how we're going to work with them. It's part of our criteria.
Yeah, yeah. So my favorite is C that's heading to B and maybe even A
Yep.
because you know some things that are happening. I mean, just an example, and this isn't private or anything, but a lot of people know that in Chicago there's the Obama Library coming in and the University of Chicago expanding, and it's just in those areas that's hot. That's like maybe C and maybe even C minus, but heading in a different direction. So, we want to know that there's a lot of money behind renovating. So just our investor money is not going to do it. It's going to have to be that the cities are behind it too, and they're investing in themselves. And then with all that momentum, you can really see change happen. Let's see. Someone said, great stuff. So I will pass that on to Adam and Tim. Great stuff. I'm in China and India for November, and I'm scheduling December to travel. Can you let me know any dates for December in California? Well, we have our December 8th event and December 9th, and I don't think we have any tours scheduled, but maybe we should. So
Yep,
we'll work
I'm
on
on it. I wrote it down.
Awesome. Okay. Do you plan to have a live event on the East Coast? We do. We have the date set now. And shoot, I'm sorry it's going to be kind of out there, but it's February 9th is our East Coast event. But you know what's great about that is we will actually know, possibly, we will possibly know the final rules by
Mhm.
then.
And
So,
the beauty of that one will be, Kathy, is I'm having the mastermind with our affiliates on the 7th and 8th, the day before the event. So we will be really clear by then exactly what's going on.
yep, yep, for sure. All right. A couple more questions. I know we're going over, but I'll just try to get to these if y'all don't mind. Um, any plans on visiting New York for a conference? If I'm invited, sure. Love New York. But I don't, I was hoping to get out. There's an opportunity zone conference there, and I'd love to go. So hopefully soon. Um, it's not qualified because of the, yeah, okay. So this investor said, no, it's not a qualified, the entity that he has contract in is not 90% opportunity zone. So this is a great question to ask Ryan. He's been awesome. You can just look up Indigo Spire, Ryan Shellhouse. He's been answering our members' questions, and he can let you know what you need to do, and he can help you set up the entity you need, or if you can even do it. As far as I know, I haven't seen any like arm's length type law. I don't know. Have you guys?
No, and
Yeah.
Ryan works with us on the other fund, and he's been great.
Oh, nope. There's a couple more. Do you have to invest capital gains or just regular capital? Do you still enjoy? Okay, so that's a great question. Some people have asked before. You have to invest a capital gain, and even if, like, say you syndicate and you open up your own fund, and it's everybody else's capital gain that goes into the fund, but you don't put any of your own capital gain in, you don't get that 100%.
You,
You don't get it taxed, the gain tax free.
you
It
don't
has
get
to.
that, but you could get if you're in the if it's an area that we know is going to grow, you can capture that extra equity because there's so much money coming in that area and it's going to build up. So that is
Yeah.
another option, but you do not get the magic at the end.
Yeah, if you can definitely, if you don't have a capital gain to invest, then you could just invest in the same areas because you could pretty well guess that the value is going to go up.
Right.
Yeah. So, but the question, I think the question is, let's say you put some capital gain in and some regular cash. How does that work? And I don't know the answer, so we need to ask
Yep.
that. And I'm
That's
not sure the answer exists yet. Um, and our event on February 9th is going to be in Tampa. So, hint, hint. All right, that's the tip for those who stayed, the 95 people who stayed to the end. So, all right. Well, thank you all for being with us here. We're super excited. We're everything's in process, but we wanted to make sure you could plan. That if you were in the middle of a 1031 and you'd rather do this, you can listen to my podcast. And I just got a message from my news writer who said she took all these things and summarized it, and it's going to be our next news show on real estate news. A lot of it will be summarized there for you. All right. Well, thank you, Tim and Adam. Really appreciate all you do for us at the network.
Thank you, Kathy.
Thanks, Pat. Thanks,
And,
Kathy.
and thank you for joining us here. We don't exist without our members. So
Yep.
thank you.
Thank you to all the members.
Yeah.
I appreciate it.
All right. All right. Well, take care, everyone, and we'll talk to you soon. Bye-bye.